Welcome to the NPWC Wealth Podcast, Episode 3. Today we have Raj Tandon with us from Algonquin. He manages a very important investment in our portfolio, Algonquin Debt Strategies. Welcome to the call, Raj.
Thank you very much for having me.
Yeah, we're very happy to have you here today, especially because we got some kind of turbulence out there in the market. We're hearing some negative news about the banking sector, Silicon Valley Bank in the U.S. and a couple other regional banks, as well as Credit Suisse more recently in the last couple days. Do you have any high level comments on what's going on, or whether you're concerned about Canadian banks or your portfolio?
Yeah, so in terms of our portfolio, we are very heavily concentrated in Canada. And we do not, at the moment, foresee any systemic risk kind of translating into the Canadian economy or sector. Right now, it's more a case of panic that's kind of been driving, bank stocks down, or a little bit of the action we're seeing in the market. I think today we had a good signal as well that kind of supports our feeling that this is not a systemic problem, but more of a contained, isolated, idiosyncratic issue. And today that was the ECB, the European Central Bank, did raise interest rates by 50 basis points, which to us also signals that the central bankers, and this includes the Fed, they all talk, are not concerned about systemic issues with the financial system, but are more concerned with inflation still. Mm-hmm. And so that to us was also a very strong positive signal that they feel that this is not a banking crisis that will spread, but more contained to a few banks that had very unique situations and, to be fair, mismanaged their balance sheets. And, there's, in the sense of Credit Suisse, it's kind of been a decade-long comedy of errors in their management or mismanagement that kind of led to where they're at. So yeah, so in terms of the Canadian banks and even a lot of the larger international, globally systemically important banks, we're not very concerned.
Okay. So yeah, that makes sense. And I haven't dug into Credit Suisse too much, but I heard just, you hear on the news, and then you hear on different people on Twitter talking about how these banks have had longer dated securities on their books, like 10 years, and they locked them in a few years ago at very low interest rates, a few percent. And then all of a sudden interest rates are up, and depositors are expecting higher rates of return when they're depositing money for, a fixed income investment, like a GIC or your regular deposits. And Silicon Valley Bank wasn't really able to provide depositors with much of an interest rate because their debt was locked in at longer and lower rates. Is that kind of what happened? And then people are pulling out to get a better rate of return on their money at an alternate institution?
Well, no, it's actually more what's happened there is, because this is kind of, the model is kind of a model of all banks, which is kind of borrow short, lend long, as we call it. And where basically you're taking the deposits you have and then doing longer term lending, and you're getting you're giving less on the deposits and you're getting more from the loans you're giving out to companies.
Yeah.
And what happened in the case of Silicon Valley Bank, it was a bit unique because majority of their clientele were were corporate clients who also had deposits above the $250,000 insured mark, whereas most banks have more insured deposits. And the other kind of big difference there becomes actually, as an individual, you and I are not running to the bank and, fighting for more money when interest rates go up on our deposit, whereas a CFO of a company might, right, demand more. But really what happened with Silicon Valley Bank was, over the past few years through the pandemic, with a lot of this, money flowing around, they saw their deposits grow. I think it was 3 or 4 times in the matter of a course of a couple of years. So
Mhm.
they had all these massive deposits sitting in their bank, and they weren't even able to lend at that level of what they were getting in. So what they started to do was buy, in theory, the safest asset in the world, US Treasuries.
Mhm.
And as anyone who looked at their fixed income portfolios over the past couple of years, you've noticed that because rates are going so much higher, the value of those safe US Treasury bonds have dropped significantly.
Yeah.
So now the problem became when the clients of SVB, these venture firms and stuff, now that they're burning a lot more cash and they have higher interest payments and everything as well, they've been taking out their deposits, and because the flood of money is not coming to them as much as it was in the past, they're taking their money out of the bank, and now the bank is selling those bonds at a major loss.
Yeah.
So that's why the Fed has stepped in, and the U.S. Treasury and the deposit insurance companies, to say we will insure everybody over 250 as well.
Yeah.
So you don't need to panic and take your money out and
Yeah.
force the bank. But they've also said to the banks, if you deliver us your government securities, those treasury bonds that went from $100 to $80 or $90, we will value them at par
Okay.
and give you a loan. And I
Wow.
mean, that's going to hurt the profit of the bank because that
Yeah.
loan is still at a 5% type of level,
Mhm.
but it's not going to force them to take the losses that Silicon Valley Bank had to take.
Right. Right. So that's a huge help to those banks, and obviously very fortunate to all those businesses that bank there over
Yeah,
$250,000.
yeah. Because I think that's and I think to us, it's not a systemic problem. It's more like in the actual banking system,
Mhm.
it's more of a problem of panic,
Yep.
right? So if investors or depositors start panicking and taking all their money out, it becomes a kind of self-fulfilling prophecy. So I
Yeah.
think that's where, even today, a move by the central bank, by the ECB, to raise by 50 basis points is hopefully a signal to deposit holders that they should not be concerned. And then obviously with what the Fed did and the Treasury to say to U.S. Depositors over 250K that you're still insured,
Mhm.
that you don't need to go to your bank and take all the money out and run.
Yeah. Yeah. All right. So I just wanted to pull up a few of the slides that you had put together for us, so we can get a bit of a better understanding of how your investment makes money for investors. So I'm just gonna pull that up. All right. So Algonquin Capital. So if you just want to kind of talk us through, and I'll move through the slides for you.
Yeah, I guess at a high level, just to give kind of an introduction of what we're doing,
Yeah.
is first of all, our strategy, like one of our investors likes to say, is founded on the idea of robbing banks. In that, my partners and I are all former bank traders and managed fixed income desks at the banks, and our idea was really to take the strategies that we executed for decades in the banks and that institutions use, and repurpose them and package them for Canadian investors. So to give them access to a different manner of managing fixed income, which
Hmm.
we felt could give people a much better outcome.
Hmm.
And really, it's designed for investors who want more out of their fixed income, but don't want to sacrifice quality, transparency, and liquidity. So what we're offering really is an alternative to something such as high yield or private credit, um, where our philosophy is rather than going hunting for that extra yield or return in lower quality securities, we add more of the good stuff in that we're offering exposure to high quality investment grade companies, the credit exposures,
Hmm.
while hedging out all the interest rate risk.
Okay.
And our thesis there is that credit exposure of a high quality, large cap, strong company is giving investors strong compensation for the underlying risk that this company goes bankrupt. So we think over the long run, it becomes a better alternative to lower quality assets, in that the client gets the security and safety of, and understandability and transparency of how they're generating that yield.
Yeah. Nice. And I think as we go through these slides, I think that'll become more
Yeah.
clear exactly how that's done.
how
Yeah.
it actually happens.
Yeah.
So if we start here with, just as an example, and we've kept the numbers nice and round to keep things simple, is a Royal Bank 3-year bond that has a yield of 4.5%.
Mm-hmm.
Now, that bond has two parts to it: the interest rate component and the credit component. And the interest rate component would be really what you would get from a government bond.
Mm-hmm.
So that's determined by where government bonds are trading.
Mm-hmm.
And then the credit component, or the credit spread, is the amount above the government that RBC needs to pay in order to compensate an investor for the additional risk of taking Royal Bank debt over the Government of Canada debt.
Okay.
And obviously, that will be dependent upon the quality of the company. So just like if you go to the bank and somebody else goes to the bank, you might get loans at different rates depending on your credit rating and your credit quality.
Yeah.
So similarly, RBC has to pay less of a premium than Rogers,
Gotcha.
or Ford.
Yeah.
So that's the kind of two parts that make up that 4.5%.
Okay.
And historically, it's that interest rate component that is driving most of the ups and downs that an investor sees in a bond price.
Yeah.
Because the probability that Royal Bank goes bankrupt doesn't change materially.
Mm-hmm.
The spread on that Royal Bank bond will change more due to market sentiment, the ups and downs of the market. But, as we've experienced in the past few months, interest rate volatility can be much greater.
Mm-hmm.
So what we do is we actually eliminate the interest rate risk. And we do so by pairing the purchase of the RBC bond with a short sale of the Government of Canada.
Okay.
So now when interest rates move, if we go to the next slide.
Yeah.
Now when the interest rates move, the two positions offset each other from the interest rate perspective.
Okay.
So, when interest rates go up, bond prices go down. So we would lose money on the RBC bond, but we would make that money on the Government of Canada bond.
Okay.
So in essence, we've eliminated the volatility and risk that comes with movements from interest rates.
Yeah. So you've been able to isolate that difference between the 3% Government of Canada bond and the 4.5% RBC bond.
Exactly.
And so you can make that just 1.5% interest in the middle without interest rate risk. If interest rates go up or down, you're kind of offsetting each other either way.
Exactly. So if we kind of scroll through, we'll see so interest rates move, there's no impact to the package.
Yeah.
And then to your point, what we've ended up isolating here is that credit spread.
Gotcha.
Yeah. So here's that 1.5% that you're getting compensated for the risk that the Royal Bank goes bankrupt and defaults on their loan obligations.
Yeah.
And because we feel that the probability that Royal won't be here is de minimis, and we're very comfortable with that exposure, we apply leverage to that credit spread.
Yeah.
And by doing so, we then are able to build a portfolio where we're able to generate yields in that 7 to 10% range today,
Mm-hmm.
without any interest rate risk. And we're doing so through high quality exposure.
Yep.
And our thesis there is, for example, in today's current environment, we would much rather have the additional exposure to RBC than to be going into weaker companies in order to get that extra yield.
Mm-hmm.
Because, particularly in an in an uncertain economic environment, we feel investors will sleep a lot better at night knowing that they're deriving their yield from the RBCs, the Bells, the Rogers, the Loblaws of the world, rather than a lower tier company they've never even heard of.
Yeah. So, so what is the risk there for permanent loss of capital? So if you're isolating the spread between the two
Mhm.
bonds, you're using that 1.5%, you're leveraging the portfolio up, looks like maybe 5 times here, 4 or 5 times, and so you're getting a 7 to 10% return by using leverage to isolate that 1.5. Is there any way to permanently lose capital or
Yeah.
to have a loss for a significant period of time?
Yeah, the way to permanently lose capital would be, in this example, if RBC goes bankrupt.
Okay.
So they actually don't pay on their bonds.
Yeah.
And the reality actually there, which is kind of an interesting thing, is a lot of people assume, well, if RBC goes bankrupt and you own $1 million worth of their bonds, you just got wiped out. But the reality is most of the high quality companies, even if they go bankrupt, you're still getting, maybe anywhere from 70 to 90 cents on the dollar because they have assets to
Right.
sell and the bondholders are the first in line.
Right. That
But
makes sense.
so while it's a de minimis risk, it's never zero. So we
Yep.
always like to, inform clients that, that is the risk of permanent loss of capital.
Mm-hmm.
And then in terms of the more salient or relevant risk for most people would be if that RBC spread goes from 1.5% to 2.5%, which it was in March of 2020, that move would create a temporary loss on the bond position.
Mm-hmm.
And then it really becomes about, obviously, if an investor sells at that point, they are crystallizing their loss.
Yeah.
So then, for example, in March of 2020, that is what happened. The RBC spread went from, below 100 to 250,
Mm-hmm.
and that created a paper loss, which then we recovered in the subsequent months. But obviously, if somebody needed to sell in the end of March, they were taking that loss.
Gotcha. So it's kind of like if you own an individual bond, if you buy an RBC bond at 4.5% and interest rates go up, and now RBC is offering those bonds at 5.5% because that's what they have to offer to borrow money, then the 4.5%, nobody wants to buy that off you. So you'd have to sell it at a discount to sell that bond to somebody else. But as long as you wait till the end of the 3-year period, you're getting your 4.5% a year and it all works out. Is that similar in your
Exactly.
strategy?
It's exactly because the
Yeah.
underlying is still bonds.
Yeah.
It's the exact same where, in March of 2020, for example, we saw that RBC bond go from $100 to, let's say, $95.
Mm-hmm.
And so that's where we took the paper loss. But then as that bond goes back to 100, you're going to make that $5 back.
Right.
So as long as, you're not capitulating and being forced to sell,
Yeah.
you're able to, sit, like to your point, sit back and say, okay, as long as RBC doesn't go anywhere, I'm going to earn that yield.
Okay. Awesome. And then if it's not too kind of detailed to explain, how does the leverage work? Because I guess in layman's terms, when you're thinking about leverage, you're thinking about going and borrowing money from the bank. So
Mhm.
if somebody invests $100 with you, it almost feels like you have to go and borrow an extra 400 to, put 4 or 5 times leverage together. Is that the process to get that 5 times leverage? And how would would increased interest rates make it harder to earn a return in this portfolio because of the cost of borrowing? Is that how
No,
that
so
works?
actually, no, short answer. But
Okay.
yeah, the way we get our leverage is kind of like in the example. If let's just stick with our example. So if you gave me $10 million
Hmm.
cash, I give that $10 million cash to my prime brokers. So that's TD, CIBC, BMO. And let's just say I'm using TD Bank as for with and what the way I get that leverage is through the short government sale. So what I'm effectively doing is I'm borrowing the government bond from TD Bank
Hmm.
and then selling it into the market.
Yeah.
And let's say in this example, you've given me $10 million cash and you said, Raj, I want you to lever this 5 times. So I would go and sell 50 million government bonds, raise that $50 million of cash, and go buy 50 million RBCs.
Hmm.
And because I'm borrowing that government bond from TD Bank, my prime broker, I pay a fixed fee for that borrow.
Okay.
So the interesting thing there is that while I'm obviously paying, like in our example, the 3% a year on my short Canada, I'm earning 4.5 from my RBC.
Hmm.
And so when rates go up, the rate I'll get from my RBC goes up and the government will go up, but they'll both go up and down together.
Yeah.
So I'm only concerned about that spread still. And I'm just paying a fixed fee for that borrow cost.
Okay. And the institution is okay with that because they have all of these assets on their book. And as long as you're, you know, if there was like a temporary loss, as long as it's not too significant, your initial investment covers it. So you don't have a problem.
No, exactly. Exactly to your point. And the fact is that because what we're borrowing is government bonds, it's a massive market and liquid market.
Hmm.
So, that's why the bank is comfortable lending us those government bonds. And because they stress test our portfolios, because they're very strict post 2008 in extending leverage, and they see the quality of the bonds we hold, they're very comfortable that even, for example, even in March of 2020, we were nowhere near having a problem with the bank.
Okay. Yeah, that's good to know. And I'll pull up your fun fact sheet here as well, just so we can take a look at it after this slide.
Yeah, so this is actually the current um, portfolio, how it's set up. And I think one of the nice things right now is that we're earning a yield of 9 to 10% on the portfolio. And yet we're also running probably one of the highest quality portfolios we've ever run, where the average quality is A minus and the average maturity of those bonds is 2 years. So our concentration is in high quality short dated bonds.
Hmm.
Again, the interest rate exposure is close to zero. We're very heavily exposed in Canada. Right now, also, Canadian credit is a little cheaper than the US, so it's offering a bit better premium.
Hmm.
And then the other thing there on the slide is just as a side note, is one of the unique features of our strategy is that for corporate accounts, the return is categorized as business income. So, on top of the benefits of the strategy in and of itself, there is the additional bonus for a corporate account that it is taxed as active business income. And so, it would be taxed in Ontario at the 26.5% rate.
Okay. As opposed to interest income.
Or as opposed to, and now that the new corporate rules, it doesn't also affect your small business deduction if you're an active corp.
Oh, wow.
And so it doesn't fall into that passive investment income that has kind of hampered corporations lately or since
Gotcha.
2018.
Gotcha. And that 9 to 10% yield, is that so if you just hold the portfolio exactly as it is it a 2 year period that 9 to 10% yield is realized?
So per annum though, that's per
Oh,
year.
annually.
Yeah.
Okay.
Yeah.
So
So right now, because one of the nice things today for investors is that credit spread, that RBC, for example, that RBC end of 2021, the spread would have been 0.6%. So it's just 60 basis points.
mhm.
As of last night, uh, it's probably like 160. So you're earning a lot more. And there's also the potential, well, typically credit spreads of high quality companies mean revert. So they come back down. And normally we would expect that RBC to be, around 100 or sub 100.
Yeah.
So the nice thing right now is for an investor who can hold the position, we do feel, there's the potential over a 2-3 year period now to look back and have annualized at least at that high single digit, maybe even low double digit. It's just that, as things happen in the market, it might not be a straight line.
Yeah.
You could get 0 this year and 20 next year.
Yeah.
Or you could get 5 one year, 15 one year.
Yeah.
But the nice thing is, to your point, is if you're even a medium term investor, the probability that you will, on an annual rate, get towards the yield is pretty high degree of confidence.
Yeah. And like with this type of portfolio, there can be like better times to enter it uh based on the setup. Because I know in 2020 there was a great opportunity, partway through the year to enter this portfolio. It had a very high kind of internal yield built into it. Could you comment on that in 2020?
Yeah, so in March, because of, I mean, a part of the widening or that move in the credit spread, like, so for example, I said RBC was trading at 2.5% rather than today around 1.6. And part of that move was, concern over the pandemic and credit risk. So obviously, we weren't that worried that RBC would go bankrupt, but the probability was materially higher in the middle of
Mhm.
a pandemic, or especially in March when we didn't know what was going on. But the other big driver of that move was also, I'll call it the dash for cash. That in
Mhm.
March of 2020, the most important thing for anybody was cash, right? And so
Yeah.
they were selling their RBC bonds to raise cash because those are liquid instruments that they can sell. So that caused a very dramatic move in that credit spread. So when those credit spreads are higher, it typically results in a better entry point. I
Yeah.
mean, it wouldn't be that different than thinking about when the stock market is down, usually a better entry point.
Yeah. Yeah. Yeah.
So it's similarly that way where when credit spreads are wider, it's better. And today, the nice thing is that if in Canada, the average is usually around 1%, today we're a good, 60-70% above that. So
Mhm.
we're trading significantly above the average today. So right now, like I can tell you, is like, a year ago, or even towards the end of 2021, 15 months ago, that yield that you see of 9 to 10 would
Mhm.
have been more like 4 to 5.
Yeah.
So, and if anything, higher interest rates are also a little bit of a benefit to us.
Okay. So it's a good environment, and that 9 to 10% yield annualized. That sounds great with the level of risk that we're taking in this type of investment.
Yeah, and just to give you some color there, is we're actually probably 75% of our usual level of exposure and leverage.
Hmm.
So we've actually, our balance today is, yes, there's very attractive value in the high quality credit, it's liquid and it's secure, but we're still in a very uncertain economic environment. So we want to be kind of take that balance to say, let's focus on high quality and leave ourselves some room to maneuver. And, if we actually see greater weakness, to maybe even potentially be adding exposures at more attractive levels.
Nice. Yeah, that makes sense. And I just pulled up the fun fact sheet, the kind of performance for the portfolio. So since inception, 7.93%. And you can see some years perform better than others. And what is the benchmark? What are you looking to outperform in this type of portfolio?
I mean, we don't really have a benchmark per se, but we would say, because there's really nothing out there like what we do. I mean, I would say the best kind of, for me, comparison is really high yield.
How you?
And in the sense that, we feel that what we're offering is typically better returns than high yield for a similar or maybe less volatility.
Mm-hmm.
But the biggest difference is a much lower risk of permanent loss.
Mm-hmm. And what's it? Do you have like a forecast for 2023? Like I know you have the
No crystal
yield there.
balls. Yeah.
Is that it? Kind of the yield? Would that be 9 to 10%? If you could give us a best forecast?
Yeah. Honestly, like the reality with most fixed income is exactly what you said, is the best forecast is your yield.
Mm-hmm.
And like I said, is that I think in any given year, it's always difficult to know. Like, for example, this month, so far in the past couple of weeks, because of the panic, we've seen, RBC go from 1.4 to 1.7% spreads. So that little move is now obviously taken, down maybe 0.5% to 1%
Mm-hmm.
for us. So it's those kind of moves are always unpredictable.
Yep.
But the best gauge would be the yield. And for, again, an investor who can hold the investment in the medium term,
Mm-hmm.
typically when they look backwards, they'll say over a 3-year period, I earned that yield.
Yeah.
On an annual basis. And like we
Yeah.
said, it could be 0, 20, 10, or 5, 15, 10. So, but what we would hope is that at the end of the period, the clients are earning in and around the yield.
Yep. Yeah, that sounds good. And then what's the long-term return projection? Because any client that we put in our private investment portfolio, we're looking at that like at a minimum 3 to 5 year investment horizon. We try to think of that for all of our portfolios. We want kind of people to be invested for the longer term. So do you have like a long-term kind of return profile that you're looking for?
Yeah, I'd say it's somewhere in the 5 to 8, maybe even 6 to 9, depending on the environment. So that's the long-term kind of projection. And like, as you can see, we've annualized at around 8, but we would say it'd be about that 5 to 8% type of range. I mean, this is not a strategy where we're looking to hit home runs. It's more of a strategy where you're looking for consistent singles, doubles.
Yeah. And the big thing for us is lack of correlation with the public stock markets, because everybody is mostly exposed to public stock market or traditional fixed income, just buying an RBC bond or a portfolio of bonds. So what's the correlation like to those markets in this portfolio?
So there is some correlation to equities. It would be kind of like similar to high yield, where when there's big moves in the equity market, it just drags all risk up and down.
Mm-hmm.
But usually it's a very muted risk. So historically, what we've seen is in this type of strategy, if the stock market is down 20, you could be down 5.
Yeah.
And if the stock market is up, that'll be positive for credit. The biggest kind of, let's call it, diversification benefit is that we actually have very little correlation to traditional fixed income. And that's because we've removed the interest rate risk. So for example, like last year, we have a minus 1.86, whereas most bond funds were down double digits.
Hmm.
And the main reason the bond funds were down double digits was interest rate risk.
Yeah.
And because we don't have that, we actually have a very low, almost zero or negative correlation to traditional fixed income. And the reason last year that we had um, a difficult result or a negative result was because we endured that move where RBC spreads went from zero point 0.7 to 1.7.
Yeah.
But again, the nice thing to your point is now the yield is 9 to 10 after that type of move. So then, while investors might not be thrilled with the past couple of years, it kind of then smooths out in the next few years where we hope to outperform.
Yeah, yeah, like we were kind of talking about earlier, like this is a good entry point
Yeah.
for this type of strategy, and
I,
the
I,
negative
can, I
one.
can tell you, I can tell you with all honesty, my partners and I are adding.
Good, good, yeah, that always gives confidence when the partners
Yeah,
add. We want to add.
March month end, because it's month end. I've pretty much at least two or three of us, pretty much probably all of the founding partners are looking to increase their positions.
Okay, yeah, that's definitely good to know. And like you said, even last year, negative 1.86, when the bond markets are down double digits, the equity markets on average are down double digits as well. It's a big diversifier.
Yeah, yeah. I mean, it's like I said, and big, like part of that minus 1.86 is because we had such a big move in the equity market. But
Hmm.
then, to your point, it's a diversifier that it's much more muted. And then you also, what I always like is even in March of 2020, um, because of that liquidity crisis, the pain was greater than one would have assumed in a strategy like this. But the nice thing was being able to sit down with clients and say, this is our portfolio. It's, most of the bonds at that point were even under 1 year because we were
Hmm.
defensive. And, as long as you can hold this, the expectation is recovery and back to, making a profit. And as you can see, at the end of 2020, we ended up the year on the positive side. So it's one of those ones where it's nice as well, because even when there is turmoil in the markets, the client has that security of, okay, well, my risk here is really that the big, strong Canadian companies start going bankrupt.
Hmm. Yeah, yeah, a risk most people are willing to take on, and everybody's invested in them anyways. They're in every portfolio. So
One of my clients likes to tease me is that if the Canadian banks go down, we've got much bigger problems than your fund.
yeah, yeah, exactly. And so if the typical investor out there is 60% equities, 40% fixed income, or something like that, if they're adding Algonquin Debt Strategies Fund to their portfolio, do you find like most investors would use it to replace their fixed income, or would they use it to replace their equities?
You know what? That's an interesting one. Is historically we found in a low interest rate environment, people were using it to replace their fixed income, right? And again, that like higher income sleeve of a fixed income portfolio.
Hmm.
So not your, low, very safe kind of stuff, but that high yield or things like that. Um, Now, when people get nervous about the equity markets, it's often used as a part of their again, that high yield type of instrument where it's kind of a muted equity position. So I think it depends, but we personally view it as a more of a natural fit in that high income portion of a fixed income portfolio.
Okay. Yeah, that makes sense. And do you have any comments on the sentiment out there? Are people, from your perspective, nervous about the equity markets at this time, or do you feel like they've kind of pulled back and now people are okay at the levels that we're at?
I mean, I think the sentiment is still from the psychological perspective on the negative side. But the way we've seen things already this year, things just swing so dramatically in the matter. Like it feels like every month the sentiment shifts. Like, just to give you a little color, like look at January, we had interest rates come down almost 0.5% because everybody thought inflation would be coming down and central banks would be able to cut. Then we had interest rates in February because we had strong jobs and inflation was coming down, but not fast enough. It went up 60 basis points. And then obviously after SVB, it dropped 1%. And then since then, we've had wild swings. So market sentiment seems to be shifting a lot faster than normal.
Mm-hmm.
But there does seem to be more of a tilt towards some fear right now.
Okay.
And I think a lot of people's fear is the impact we've seen so far has been mainly driven by the interest rate market.
Mm-hmm.
And that maybe we haven't yet seen the full extent of the impact to earnings of the higher rate environment yet,
Okay.
and a potentially slower economy. So I think the concern is still that right now that the central banks raising rates so high will obviously have unintended consequences, as we've seen with SVB and Signature Bank. But I think sentiment is there. I mean, whether that means that we should all be running or anything, no, it could be a good buying opportunity. Who knows?
Yeah, yeah. And I think we see a pretty similar sentiment out there. And I think now, just like most of the time, diversification is very important. Having a diversified private portfolio, diversified
Probably
public
more than
portfolio.
ever.
Yeah.
In good markets, you don't need to think about diversification because everything is rocking for you.
Yeah.
It's in times like this where you want to sprinkle your positions more broadly.
Yeah. So on that, like, we really appreciate you, Raj, for taking the time and for running this investment that helps our clients and our portfolios a ton with their diversification and long-term returns. And hopefully we'll be able to have you back in for another interview shortly.
Oh, please, would love to. Thank you so much for having me. And and obviously thank you to you and all your clients for the support and faith in us. And look, we love doing things like this too, because our raison d'etre is to help Canadians get better results from their fixed income. So we do so obviously through the products, but also through sharing knowledge and ideas.
Awesome. Yeah, we look forward to speaking with you again soon.